currently what we are doing. So we are basically present in all omni-channel marketing across digital and offline platforms currently. We are focusing more on product visibility with consistent engagement and brand identity. Obviously, we'll be currently going through our own website changes where we'll be selling as well on our own website. Again, we are increasing our on-ground visibility for in-store branding and retail activations, and we'll be going for influencer collaborations and digital campaigns to build awareness around the brands. Business development initiatives, we have already started, participating in global toy fairs. We just recently participated in Nuremberg toy fair. So our aspirations are always to go global with our own IPs, and we have started doing that. So that is one thing we are focusing on. Again, we are expanding our retail and e-commerce through curated product offerings. That's we are currently doing. And again, we are also getting into branding initiatives aligned with evolving customer preferences. Again, regional growth focus, we are expanding into Tier 2 and Tier 3 cities as well. We have already opened an office in Middle East called Striders Hub under the Striders Hub name. There we'll be focusing on Middle East side of the business. We'll be directly distributing the range to the retailers like what we do in India. And Striders LLC will take care of the global business. Again, other global regions we are focusing again to go through other major distributors and retailers through Striders LLC. Again, these are some of our key business trends. We don't own any manufacturing. Both myself and Mustafa come from a strong product development background. So we focus on product development, product designing, etc., acquiring licenses, developing the products and distributing it. We exactly know how the gaps are in the market, what kind of price points work because of the kind of previous experiences what we've had in retail. Rather than going capex heavy, we decided to be capex light and invest more into products and distribute them. Again, strong licensing partnerships. Mustafa again comes back with a very strong licensing experience, and we are again leveraging that to acquire good licenses across India as well as other parts of the globe. Again, we are increasing our own IP strength very strongly with multiple brands, and that will help us strengthen our brand value. Through Striders LLC and Striders Hub, we are strengthening our international presence as well. We are focusing on e-commerce with the hiring of Manish Dalwani, whom we just mentioned on the e-commerce side of the business. Again, if you see our revenue base is quite diversified. So we are working across licensed IPs, we are working across own IPs, and we are working across different categories. So we are not dependent on either one license, nor on one category, or nor on one IP. So the risk is pretty leveraged, the risk is pretty diversified, and that's how we want to operate. Again, balanced portfolio, and again, we have a dual country supply chain advantage. Again, we both come back with an experience where we have experiences working with China very closely and working with India very closely. So wherever there's sourcing options which are available from India, we are exploring that in a very big way. We are using the Indian manufacturers to supply toys into the Indian market. Whereas for global suppliers, we are also evaluating the China supply chain, where we have obviously honed our skills through multi-channel years to supply them to global distributors as well. So we both are attuned to both India and China very well, and we'll be using this balanced strategy to supply globally from India as well as from China. Again, this is a SWOT analysis. Strengths, we have already spoken about strengths in the last slide. Weaknesses, yes, dependence on external manufacturers. Yes, we don't own manufacturing, but between us, we know multiple manufacturers who can do stuff for us. So, scale is not an issue from us. We have multiple manufacturers who can, expand the manufacturing facility as and when needed. Again, it's a distribution business, it's working capital heavy business. So between India and Middle East, where we will be distributing directly, we will be needing working capital, to operate. So that's in GCC market, we are entering directly, as we mentioned with Striders Hub. The market size currently is $1.8 billion. The market size compared to India looks small, but it is a very critical market for us because it's a rich market. Again, people spend money there, people have the ability to obviously, consume more. And because of my previous experiences in Middle East, I understand that market pretty well. So we decided to venture into Striders Hub directly in the Middle East, to capture that market as well. It will give us obviously a better leverage in terms of operational efficiencies. Now, if you see the global toy market, it's huge in the sense between India and Middle East. That's just a very, very small part of the global toys market. And as I mentioned earlier, our aspirations, whichever brand we create, are to go global with our own IPs. So we will be targeting, and we are already targeting with participating in international toy fairs with our brands to enter global distribution. So we will be entering global distribution to distributors as well as other retail networks as and when obviously we move ahead. So Strider's FZ LLC, which will be taking care of the global side of the business, will play a very important role in our growth. Again, this is a peer comparison. I will let Manucha ji to handle this part.
Yeah, we have given two companies comparison. One is Strider's Impex along with OK Play India Limited. At that point of time, there was no other company which was in the listed space of that size. So although after the DLHP was filed, KV Toys also came public, and that is a listed company that's also doing well. I can only compare with these two companies. However, I leave up to you to see the comparison between KV Toys and Strider. The valuation of Strider is definitely far better than the KV Toys, but I leave it up to you to compare. With respect to OK Play, face value of OK Play is 1 rupee and the face value of Strider is 10 rupees. Current market price for OK Play is 5.49. Our current market price is going to be the issue price as of now is going to be 72 rupees. The range is 71 to 72 rupees. EPS for Strider is 6.27. OK Plays in the result was loss, so it's a negative EPS. P ratio will be decided based on the price whichever is listed in the market. Return on net worth is 56.51% for Strider, and since there was a loss, so it's a negative. NAV per equity share is 11.09 as for Strider, and for OK Play it is 4.43. With respect to financial numbers, total income of the company has been steadily increasing. As I mentioned earlier, that it was not only the hard work of 5 years, but the experience which they have between themselves, more than 40 years both put together. And FY23 it was 29.96 crore, which rose up to 61.95 crore for the consolidated numbers as of FY 2025. For the first 9 months ended, it is 49.61 crore. Mainly, if you see that in the past also, their last quarter actually gets more than 40 to 45% of the total revenue. And with respect to EBITDA, again it has been hovering between 10.32% to 15.07%. It was 3.09 crore as of FY23, increased to 9.32 crore as of FY25, and for December 25 for the first 9 months it has been 6.49 crore. Likewise, PAT also increased from 2.03 crore, it increased to 8.40 crore for FY25, and for the first 9 months ended December 2025, it was 4.01 crore. Return on capital implied is comfortably placed at 25.98% as of December 25. Debt to equity ratio, generally company does not have long-term debt, they are having working capital limits only, and they have only small portion of around 2.5 to 3 crore rupees in the long-term loan from one of the NBFC, which is one of the object issue for the repayment around that amount. It has come down from 2.02% to 0.97% as of December 25 times, 0.97 times. Current ratio is comfortably placed at 1.50 as of December 25. Receivable turnover ratio for December 2025 for the 9 months, it has been at 2.37 times. With respect to profit and loss statement, I have already told it has increased from total income has increased from 29.96 crore to 49.61 crore. EBITDA has increased from 3.09 crore to 6.49 crore. PAT has increased from 2.03 crore to 4.01 crore as of December 2025. And now let me take to the balance sheet. As you see the balance sheet, as far as the total equity is concerned, net worth of the company has increased from 2.08 crore to 24.12 crore, and total size of the balance sheet has increased from 17 crore to 48.70 crore as of FY 2025, and for December 25 it stood at 58.83 crore. Investment rationale, most of the things have already been covered by Mustafa and Kumar. It's an asset-light, capital-efficient business model. They enjoy the balanced portfolio of global brands as well as their own proprietary brands. Over the last 3-4 years, it has exhibited a good profit from almost now it stood at 8.4 crores from 2.09 crores. Their profit margins, operating margins have been increasing, and they have the omni-channel distributions with pan-India reach. They enjoy the strong relationship with leading retailers and institutional partners, and they have actually expanded to international boundaries by setting up their subsidiaries in UAE. And their main core expertise is the brand development, product innovations, and faster go-to-market. Balance sheet of the company has been improving steadily. You have noticed that. And promoters have got relevant experience of, each one of them have got 18 to 20 years of experience. Issue highlights, we'll now touch upon the issue highlights. Total size of the issue is 50.40 lakhs equity shares. Of fresh issue is 45 lakhs 31,200 equity shares. Offer for sale is 5 lakh 8,800 equity shares. Face value is 10 rupees. Issue size is 36 crore 28 lakhs. IPO price band is 71 to 72. Lot size is 1600 equity shares. Issue is opening on 26th of February. Issue is closing on March 2nd, 2026. Offer structure is 50% is allocated to QIB and anchor investors, that is not more than 23 lakh 90,450 shares. HNIs have been reserved at 7 lakh 22,000 shares. Individual investors at least 16 lakh 76,850 shares. And market maker will be subscribing to up to 2 lakh 52,850 shares. Pre-issue shares is 1 crore 40 lakhs 85,680 shares. Post issue it's going to be 1 crore 86 lakhs 16,880 shares. Post issue market implied market cap at the upper band is close to 134 crore. Promoters and promoter groups pre-issue enjoys 95.49% shareholding, with public is having 4.41%. Post-issue promoter shareholding will fall to 69.52% and public will have 30.48%. Issue is slated to be listed at NSE Emerge platform. Objects of the issue, mainly as I mentioned, mostly they will be using for the working capital requirements. They require around 10 crore rupees for Indian operations, 4.5 crore rupees working capital requirement for Standard FZ LLC for global business operations, and 6.50 crore for their subsidiary in mainland UAE. They will require working capital requirements, and 3 crore rupees will be the repayment of loans. Remaining money will be for the general corporate purpose and issuer classes. With this, I thank you all once again for